This chapter deals with the statement of cash flows. So what we want to do first is to identify the purposes of the statement of cash flows. The balance sheet reports financial position, and balance sheets from two periods show whether cash increased or decreased. But that doesn't show why the cash balance changed. The income statement reports net income and offers clues about cash, but the income statement doesn't tell why cash increased or decreased, because the income statement is prepared using accrual accounting rules that ignore when cash is received or paid. And so this is why we need the third financial statement. The statement of cash flows reports cash flows, cash receipts and cash payments, where cash came from or receipts and how it was spent, those payments. The statement covers a span of time and therefore is dated year ended December 31 or 2012 or month ended June 30, 2012. The statement of cash flow serves these purposes. It predicts future cash flows. It evaluates management decisions, that is, businesses that make wise decisions prosper and those that make unwise decisions suffer losses. And so the statement of cash flows reports how managers got cash and how they use cash to run the business. Thirdly, the statement of cash flow determines ability to pay dividends and interest. Stockholders obviously want dividends on their investments. Creditors demand interest and principal on their loans. So the statement of cash flow reports on the ability to make these payments. And then finally, the statement of cash flow shows the relationship of net income to cash flows. Usually, high net income leads to an increased cash and vice versa. But cash flow can suffer even when net income is high. Next, we want to distinguish among operating, investing, and financing cash flows. A business engages in three types of business activities: operating activities, investing activities, and financing activities. Operating activities create revenues, expenses, gains and losses, and thus net income, which is a product of accrual basis accounting. The statement of cash flow reports on operating activity. Operating activities are the most important of the three categories because they reflect the core of the organization. A successful business must generate most of its cash from operating activities. Investing activities increase and decrease long-term assets such as computers, land, building, equipment, and investments in other companies. Purchases and sales of these assets are investing activities. Investing activities are important, but they're less critical than operating activities. Financing activities obtain cash from investors and creditors, and so issuing stock, borrowing money, buying and selling treasury stock, and paying cash dividends are examples of financing activities. Paying off a loan is another example. Financing cash flows relate to long-term liabilities and owner's equity. This figure shows how operating, investing, and financing activities relate to the various parts of the balance sheet. There are two ways to format operating activities on the statement of cash flows: the indirect method, which reconciles from net income to net cash provided by operating activities, or the direct method, which reports all cash receipts and cash payments from operating activities. The two methods use different computations, but they produce the same figure for cash from operating activities. These two methods do not affect investing or financing activities. And so next we want to prepare a statement of cash flows using the indirect method. So to do this, from the income statement, we take net income, depreciation, depletion, and amortization expense, and any gains or losses on the sale of long-term assets. And from the comparative balance sheet, we compute the increase or decrease in each current asset and current liability account. The operating section begins with the net income taken from the income statement and is followed by adjustments to reconcile net income to net cash provided by operations. And so for depreciation, depletion, and amortization expenses, they are added back to net income to convert net income to cash flow. Depreciation, depletion, and amortization have no effect on cash, but like all other expenses, they decrease net income. Therefore, to convert net income to cash flows, we add those amounts back to net income. The add back cancels the earlier deduction that was included in the expenses to get to the originally started with net income figure. Sales of long-term assets are investing activities, and there's often a gain or loss on the sale. On the statement of cash flows, the gain or loss is an adjustment to net income. This adjustment is made to the operating section so the entire cash effect of the sale can be reported in the investing section. Most current assets and current liabilities result from operating activities. For example, accounts receivable result from sales, inventory relates to cost of goods sold, and so on. These are the accrual and deferral accounts that are used because of the timing differences between when cash changes hands and when the revenues or expenses are recorded. Changes in the current accounts are adjustments to net income on the cash flow statement. The reasoning as follows. An increase in another current asset decreases cash. It takes cash to acquire assets. Suppose you make a sale on accounts receivable are increased, but cash isn't affected. A decrease in another current asset increases cash. Suppose a company's accounts receivable balance decreased by $4,000. Cash receipts cause accounts receivable to decrease, so we add decreases in accounts receivable and other current assets to net income. A decrease in a current liability decreases cash. Payment of a current liability both decreases cash and the liability, so we subtract decreases in current liabilities from net income. And then finally, an increase in a current liability increases cash. By not paying for an expense immediately, the company is keeping the cash until a future period. So in exercise 12-16A, we get practice in identifying transactions as either investing, financing, or non-cash investing and financing, or a transaction that's not even reported on the statement of cash flows. So I would work through each of these examples of a transaction in your mind and see if you can come up with the same designation as this example shows. And I reference exercise 12-16A in the text for this. These are a few more examples of that. So the first step to prepare the operating section of the cash flow statement is to lay out the template as shown here. And this just gives us a model or way of thinking about each of the different types of transactions we're going to be looking at and whether we add or subtract them in our reconciliation to net income in order to get down to the bottom, which is the net cash provided by or used for operating activities, which must tie to the balance sheet. Investing activities affect long-term assets such as plan assets, investments, and notes receivable. Here we see the template for the investing section of the statement of cash flows. And so companies keep a separate account for each plant asset. But for computing cash flows, it is also helpful to combine all the plant assets into a single summary account. Also, we subtract accumulated depreciation and use the net figure. It's easier to work with a single plant asset account. Net plant assets is increased by acquisitions and decreased by depreciation expense and the book value of any assets sold. The beginning and ending balances can be found on the comparative balance sheets and depreciation from the income statements. Company records should indicate any acquisitions and or sales of plant assets. To compute the cash received from selling a plant asset, locate the gain or loss from the income statement and compare that to the book value of the asset sold. A T account of net plant assets provides the same information in a different format. It's often used because it's easier to visualize and solve for any missing amounts. The cash amounts of investment transactions can be computed in the manner illustrated for plant assets. Investments are easier because there's no depreciation, as shown in the above equation. The T account shows the same information but in a more visual format. So again, the beginning and ending balances of investments can be found on the comparative balance sheets. If the preparer knows the amount of either the purchases or book value of investments sold, we can then solve for the other amount. Just as with plant assets, the amount to be reported on the cash flow statement is the proceeds from sale, which is the The notes receivable account is increased by new loans made and decreased by collections as shown in the table in T account. And so our third section on the statement of cash flows is the financing activities, and they affect liabilities and stockholders' equity, such as notes payable, bonds payable, long-term debt, common stock, paid-in capital in excess of par, and retained earnings. A template for the financing activities section of the statement of cash flows is shown here. So again, we take the transactions, and this tells us, do we add them to net income or subtract them to net income to get to net cash provided by or used in financing activities. The beginning and ending balances of long-term debt or notes payable or bonds payable come from the balance sheet. If either new issuances or payments are known, the other amount can be computed. Interest expense from borrowing is part of net income and therefore is included in the operating section of the statement, not here with the payments of debt. So these cash flows can be determined from the stock accounts. For example, cash received from issuing common stock is computed from common stock and capital in excess of par. Recall from previous chapters that only par value is reported in the common stock account and the remaining cash is received is reported in the capital in excess of par account. Therefore, to find the entire amount of cash received on issuance of stock, both account balances must be examined. We use a single summary common stock account as we do for plan assets. An increase in the common stock account indicates stock has been issued. Treasury stock increases when Treasury shares are purchased and decreases when Treasury share or Treasury stocks is resold. If the Treasury stock is resold at a different amount than cost, there may be an additional amount in paid-in capital for Treasury stock account. Retained earnings can be analyzed to determine the amount of dividends declared. Net income increases retained earnings and can be found on the income statement. Dividends decrease retained earnings. Therefore, you can determine dividends by solving the formula here or placing the beginning and ending balances in the T account along with net income. Companies make investments that do not require cash. They also obtain financing other than cash. These non-cash investing and financing activities can be reported in a separate section under the statement of cash flows. This exhibit illustrates non-cash investing and financing activities. If a transaction involves an exchange of part cash and part something else, such as stock or a note, the cash portion is reported on the statement of cash flows and the non-cash portion is reported here. So using exercise 12-20A, the income statement and additional data of Bolton Travel products are provided. So the acquisition of plan assets was $130,000. Of this amount, $75,000 was paid in cash and $55,000 by signing a note. Proceeds from sale of land totaled $25,000. Proceeds from issuance of common stock totaled $50,000. Payment of long-term note payable was $16,000 and payment of dividends was $11,000. And we also see here that we are provided the income statement, which indicates there are service revenues, dividend revenues, and it gives us all of our expenses till we get down to a reported net income of $39,700. Balance sheet amounts are shown here. To get ready for the operating sections or operating activities section, compute the increases and decreases in the current asset and liability account. And so here we see that there is a change in cash between 2011 and 2012, an increase of $74,200. A decrease in accounts receivable from $57,000 in 2011 to $41,000 in 2012, and so on for each of these current asset and current liability balance sheet accounts. And so if we use the template for the operating section, we begin with net income. Next, we add back depreciation expense. There were no gains or losses on the income statement, so the remaining reconciling items are the changes in current assets and current liabilities. Current assets go the opposite way of the change. Increases are subtracted and decreases are added to net income. Current liabilities go the same way as the change. The increase in accounts payable is added and the decrease in accrued liabilities is subtracted. And so here we see the net cash. After we make these reconciling adjustments, we see the net cash provided by operating activities is $101,200. So then we use the additional data provided in the exercise to complete the investing section. There were two investing activities. Acquisition of plant assets was $130,000, and if you recall, of this amount, $75,000 was paid in cash and $55,000 paid by signing a note payable. The proceeds from the sale of the land totaled $25,000. So here we're adding the cash received from the sales of land and deducting the purchase of assets, that portion of which was paid in cash. And then next we move to the financing activities, where we see that there were proceeds from issuance of common stock, a positive $50,000. We paid a long-term note payable, or reduction of cash, of $16,000, and we paid dividends, or reduction of cash, of $11,000, to get to net cash provided by financing activities of $23,000. And so at this point, we solved for the net cash used for both for operating activities, investing activities, and financing activities. When we put all these three sections together, the totals of the operating, investing, and financing activities are combined to determine the net increase in cash, which is $74,200. Next, we prove the cash flow statement works by adding the beginning cash balance, or the beginning balance of cash, to the net increase. This should equal the ending cash balance. In addition, Bolton Travel would need to report the non-cash investing and financing activities. The acquisition of plant assets was $130,000. Of this amount, $75,000, you recall, was paid in cash and $55,000 by signing a note payable. And so here we're just simply reporting the non-cash investing and financing activities, of which there was just this acquisition of plant assets. And so next we want to prepare the statement of cash flows by the direct method. Previously we were working with the indirect method. The Financial Accounting Standards Board, or FASB, and the International Accounting Standards Boards, or IASB, prefer the direct method of reporting operating cash flows because it provides clear information about the sources and uses of cash. However, only a very small percentage of companies use this method because it requires more computations than the indirect method. Investing and financing cash flows are unaffected by the method of computing operating cash flows. Both cash sales and collections of accounts receivable are reported in the statement of cash flows as collections from customers. The income statement reports interest revenue and dividend revenue. Only the cash receipts of interest and dividends appear on the statement of cash flows. Payments to suppliers include all expenditures for inventory and operating expenses except employee pay, interest, and income taxes. Suppliers are those entities that provide inventory and essential services. Payment to employees includes salaries, wages, and other forms of employee pay. Accrued amounts are excluded because they have not been paid in cash. Interest and income tax payments are reported separately on the statement of cash flows, again under the direct method. For the direct method, we convert income statement accounts which are accrual-based into a cash amount. This is computed by computing the change in the related balance sheet account. To convert sales revenue into cash collected from customers, we compute the increase or decrease in accounts receivable. If accounts receivable decreases, more customers paid on account than purchased on account, resulting in more cash for the company. Therefore, a decrease in accounts receivable is added to sales revenue. Conversely, an increase in accounts receivable is subtracted from sales revenue. The same pattern holds true for interest revenue. A decrease in interest receivable is added to interest revenue to determine the amount interest received. An increase is subtracted. The computation includes two parts: payments for inventory, payments for operating expenses other than interest and income tax. Payments for inventory are computed by converting cost of goods sold to the cash basis. We use cost of goods sold, inventory, and accounts payable. Inventory is the current asset, and an increase is added to the cost of goods sold while a decrease is subtracted. Accounts payable is a current liability and has the opposite pattern. A decrease is added to cost of goods sold while an increase is subtracted. Payments for operating expenses sometimes relate to prepaid expenses such as insurance, supplies, and rent. Other times they relate to accrued liabilities such as property taxes payable. If the expense has a prepaid associated with it, add the increase or subtract the decrease in prepaid expense from the income statement account. If the expense has an accrued liability associated with it, add the decrease or subtract the increase from the expense account. To compute cash paid to employees, salary and/or wage expense is adjusted for the increase or decreases in salary rates payable as indicated in this table. And so cash paid for interest and for income taxes are reported separately on the cash flow statement. The expense accounts often have a related current liability. A decrease in the liability is added to the expense while an increase is subtracted. And so this concludes Chapter 12, where we talked about the statement of cash flows. Please go back and read the chapter and then attempt the learning exercises in Moodle. I look forward to discussing with you our final chapter, Chapter 13 of this course. Thanks very much.